Hello there, welcome to Blue Dragon Actual. Now today we are starting that 5 minute series video where we'll be considering every point for 5 minutes. Just and not try to not to exceed 5 minutes. That's because the exams are going on and these days people have limited time. And we'll see how this series goes. If this series receive good response, then we might continue with that along with the maybe we'll build up to something and there would be a big video kind of combining all the concepts in the weekend, right? So today's topic has already been covered by me in my multiple videos, ALSM and the ALSM regulations, multiple videos. This topic has been covered. So I just thought of starting with this topic because this is very interesting and important, and this is also a topic where many people uh, don't even experienced person do not have clarity. So this topic is market consistent liabilities. So what exactly is market consistent liabilities? It means that if you are suppose you are kind of trading your liabilities in the stock market, say in NSE or BSE, then whatever value you put on those liabilities, whatever the price of that liability would be, if they are kind of traded as a security, then that is called then that value would be called market consistent liability. Now in it is impossible to kind of trade insurance liabilities in stock market, right? There is no secondary market, as at least in India. In UK there might be some secondary market, but in India there is no secondary market. So that's why it is very difficult to determine market consistent value of liability. So we kind of do the estimation, or like you project it on best estimate basis, and that formula you already know. The prospective is the formula. If you do it on best estimate basis, that will be called best estimate liability. So moving on. So first of all, for market consistent liability, it is important that two parties, like as I mentioned, that the price would be kind of determined in a stock market environment where two parties are kind of willing to transact with each other. That is called arm's length transaction. That is, two parties are kind of willing. They are not kind of put in gunpoint to kind of do the transaction. They are freely and willingly and interested, and in their self-interest, they are kind of doing the transaction. So that is one of the most important thing, that if two parties are kind of willing to exchange, like someone is selling the security and someone is buying the security, so then they are doing it freely. And if you are doing that in a market so that there are a number of participants, then that is what market consistent liability is. Like if you can form a security of your liability and then you can sell it in the market. Now, what is fair value method? Now, these two are same. Market consistent and fair value method are same. So I just took out this definition from Google. It says that fair value accounting refers to practice of measuring of business liabilities and asset at the current market value. Right. So these are kind of used interchangeably. It's just people gets confused. So asset can be easily measured at liability. I mean fair value, right? Market value. Like we use like our famous Axis Bank example. So Axis Bank, the price of the share you will know automatically. I think right now it is trading at 710, 715 rupees. Some are close to 700, but you cannot know the value of your liability because it is not traded in the market. So that's why you have to use some assumption, some best estimate liability, some projection, some software to kind of come with that valuation. So that is the market value of the liability, and that is why it is called market consistent valuations. It is part of the fair value methodology. Like in accounting, if you are using the fair value method, then you have to use fair value market consistent liability for your valuation, right? But in Indian scenario, they are using or in most of the maybe where there is kind of prudence is built in, they are not using market consistent evaluation. So what they are doing they are kind of incorporating prudence in the assumptions, and that's how they're projecting. So that's why their reserve would be higher, right? And what market consistent valuation will do? So market consistent valuation will create a separation between asset and liability. Then in normal cases, like in Indian scenario, the yield produced by the asset will be kind of used to discount the liabilities. But in market consistent valuation, both are traded separately, right? Like asset will be traded as a separate security, liability will be traded as a separate security, and that's why those would be separated, and the discount rate would be something else. The yield of the asset would not be used as discount rate, right? You can use that as a reference or something like that, but it will not be directly used as a discounting. So what they are kind of discounted with, they are discounted with risk-free rate. Now, many people believe that whenever it is getting discounted with risk-free rate, it is market consistent valuation. That is not the case. Market consistent valuation means whenever it can be traded in the market, right? That's the definition. I think that is now clear. However, risk-free discounting was used because it is transparent. Otherwise, company A would be using their own discount rate, company B would be using their own discount rate, and their liabilities cannot be matched. But risk-free discounted usually is the yield produced by the uh, government treasury, right? Government treasury bond. So that is considered to be risk-free because government can print money, right? So that's why it is risk-free. Although we have seen default by countries like Greece, where even the risk-free bond carries some risk, right? But that is very exceptional circumstances. So that's why that is called risk-free rate, and risk-free rate is used for discounting so that they can be compared, right? That's the only reason. However, because so in normally insurance is a risky business, right? So earlier you were supposed to discount by 8% or 10% because of the riskiness. Now you are discounting by 4%, which is the risk rate. So that means your liability is increased, right? Your liability is increased, and because there is an increase in liability, what you have to do? You have to decrease your liability, right? So because when your discounting factor is increasing, then your liability is reduced, and your discounting factor is decreasing, their liability is increased. So what is actually done is from the best estimate liability, something called CRNHR, cost of residual non-hedgeable risk. That should be CRNHR instead of HNR. Just ignore the typos. It should be CRNHR. So that is subtracted so that the liability is kind of reduced, right? So the otherwise it would be an increasing like a huge liability, and sometimes the CRNHR can be synonymous to the risk-based capital, and that is a topic for like I'll not go into detail of what risk-based capital is because otherwise this video would be longer. So CRNHR would be subtracted, and that would kind of give you the original liability. Sometimes risk margin or risk adjustment is also added to the bill, as for example in Solvency 2, in IFRS 17, where market consistent valuation of liabilities are kind of the main important thing. So that is kind of subtracted, or that is kind of added. That is kind of added so that the if there is a misestimation, the risk margin would pay for that, or risk margin would be kind of used. And if there is a bigger event, so as for example the COVID pandemic, something which is very risky, like one in a thousand kind of scenario, then the CRNHR can be used to kind of pay for that. Right? If the CRNHR is also breached, then that's a big issue, right? The company can go insolvent. Now, sometimes the CRNHR might incorporate the risk margin. So in that case, you don't have to like there would not be a separate risk margin. So it would be best estimate liability plus your CRNHR, which will be the capital, right? Or it can be best estimate liability then risk margin and the CRNHR or the risk-based capital. These are calculated using cost of capital method, and that is a topic for separate video. So if you like this series, please kind of like the video, subscribe, share, hit the bell icon, leave your comment for any feedback. Do you want small videos like that, or do you want slightly longer videos? Please put your feedback, and yeah, see you in future videos. And yeah, I mean, thanks for watching.